Welcome to the SWIB podcast, where members of the Wisconsin retirement system can turn for timely information on the investments that help fund the state's pension system. I'm Chris Preisler, communications specialist for the State of Wisconsin Investment Board, or SWIB.
And I'm Dusty Weiss, producer of the podcast.
Private markets have become an increasingly important part of how large institutional investors build diversified portfolios, but they're also an area that can feel complex and at times misunderstood. At their core, private markets include investments that aren't traded on public exchanges, meaning they're less liquid and have historically offered investors additional return potential in exchange for that trade-off. Within this space, two key areas stand out: private equity, which involves investing in ownership of private companies, and private credit, which focuses on lending to those companies. Today, we're taking a closer look at private credit, one of the fastest growing segments of the market. What started as a niche strategy following the global financial crisis has grown into a multi-trillion-dollar market, stepping in to fill the gap as traditional banks pulled back from certain types of lending. Private credit now plays a critical role in financing businesses of all sizes, offering flexible, customized solutions that aren't available in public markets.
But with that growth has come increased scrutiny. Recent headlines have raised concerns about credit quality, liquidity, and how these investments might perform if economic conditions weaken. So what's really happening beneath the surface, and how should long-term investors think about the risks and opportunities? For the Wisconsin retirement system, private credit is one part of a broader, diversified core fund designed to generate strong, stable returns over time for members and beneficiaries. In this episode, we'll break down how private credit works, why companies choose it, and how SWIB approaches investing in this space with a long-term perspective. Joining us today are two members of SWIB's investment team who specialize in private markets. Senior Portfolio Manager Beth Holzberger and Senior Portfolio Manager Lynn Mong will help us unpack the evolution of private credit, address some of the concerns making headlines, and explain how these investments contribute to the strength of the WRS core fund.
The SWIB podcast is a regular opportunity for you to learn more about the people and funds that comprise the Wisconsin retirement system. Please make sure to subscribe in your favorite podcast app so you don't miss an episode. Share this podcast with your fellow WRS members and leave a review on Apple Podcasts so it's easier for other members to find the show. Beth and Lynn, welcome to the SWIB podcast.
Hi, Chris.
Thank you, Chris.
So to get our discussion started today, I think what I'd like to do is a little investment 101 for our listeners. Can you explain exactly what private markets are and what's the difference between private equity and private credit?
I think that's a good place to start, Chris. So in the context of investment portfolios, private markets involve equity or credit investments that can't be purchased or sold on a public exchange like those in the stock or bond market. So they're what we call illiquid. In exchange for giving up this liquidity, investors in private markets demand just a little extra compensation, which the private markets have historically provided relative to investing in the public markets. But within private markets, private equity and private credit are two of the key areas that SWIB invests in, and the two portfolios where Beth and I focus our time. To keep it simple, private equity involves investing in the equity of private companies, and private credit involves investing in the credit or credit-oriented securities of private companies. And across both portfolios, SWIB allocates primarily to what we call closed-end funds that are managed by external managers. So for a given fund, a manager will raise a fixed amount of capital at the beginning of a term, invests that capital over a few years, and then returns it to investors along with investment profits. So all during a 7 to 10 year period. Once SWIB commits to investing in a closed-end fund, our capital is essentially locked up until it naturally returns to us towards the end of that period. We might also participate directly in investment opportunities through what we call co-investments, where we invest directly into a company in equity or credit alongside the external managers.
So let's talk about the private credit market specifically. Can you give us a little history of the private credit market and how and why it started?
So, Chris, it's been around a long time, but the private credit market really took off after the global financial crisis. At that time, banks had to deal with more regulation on the amount of capital they had to hold, and they had to follow stricter rules. In response, that made it harder for them to do business, and they pulled back, creating a void in the market for lending, and private credit took advantage of that. And so you saw private credits really scale at that time from being initially a market of about a couple hundred billion to 2 trillion today. So that's a tenfold increase. In context now of the total credit market, private credit is a third of leveraged loans, leaving broadly syndicated loans and bank financing to be two-thirds. So this ratio kind of ebbs and flows with market conditions. Market conditions will have a greater impact on banks than on the private market and on the bank's ability to transact. For example, in private equity backed leveraged loans specifically, you saw that private credit gained a huge share after 2022. And at that point, they were 68% of financing of leveraged loan volume. The banks really pulled back at that time, but since have clawed back their share to be, again, about one third, two thirds where we stand today. And I should step back to explain that when we're talking about private credit here, we're really referring to what's called direct lending. And that's mostly the first lien senior secured loans that are made to companies and mostly to companies owned by private equity managers.
Yeah, and Beth, I'll add that direct lending is the biggest part of the market, but beyond direct lending, other parts of the market go by names like opportunistic, special situations, or hybrid credit. But in essence, these are all investments across the capital structure, specifically tailored to a borrower's unique needs, made on a bilateral basis. In all of these cases, the interest rates or imputed interest rates in the private credit market are underwritten at a premium to those in the public credit market.
So let's talk about that premium for a second then, Lynn, because we've been kind of looking at this from the perspective of the lender. But if I'm a borrower, I'm essentially going to pay likely a higher interest rate to borrow from private credit than public credit. So how then are private credit lenders able to charge higher interest rates than the public credit market? What are the private credit lenders offering to borrowers that they don't feel like they can get in the traditional public credit markets?
That's a good question, Dusty. So the reality is most private companies are not large enough to access the public credit market, where companies need to be reasonably scaled to gather attention from the intermediary banks and ultimately the public credit investors. And this leaves much smaller companies with limited alternatives beyond borrowing from private credit. Larger companies, on the other hand, do have more options to raise debt from either the public or private credit markets. However, private credit structures can be a little more flexible with features you can't really get in the public credit market. For example, private credit structures might have a delay draw feature, which allows the company or the borrower to get a committed loan, but draw on that loan at a later point in time. Also, interest rates could be fixed, floating, or a combination depending on the needs of the borrower. A private credit structure also typically provides a higher level of leverage through a unitranche, which is essentially a single loan document that combines senior and junior debt into one loan for the borrower. Private lenders might also lean into situations that the public credit markets shy away from. So I'm talking about corporate carve-outs or turnaround situations. Private lenders will lend into those situations. Also, raising capital from the public credit market means the borrower's financial information is made public for everyone to see, and the loan generally needs a credit rating, which takes anywhere from 4 weeks to 4 months. And ultimately, the final interest rate on the loan can change depending on the demand for the loan.
Lynn explained that really well. There are just more execution risks associated with raising debt in the public credit market. So even a larger company may choose to borrow from private credit when speed and certainty is prioritized to them over the economic terms that could be better with a bank. In other situations, it may come down to timing and macro factors, which lead to the public credit market being opened or closed or somewhere in between. And those factors affect banks more than the private credit lenders. During the windows where there is a limited public credit demand, private credit may be open even for larger companies.
So, Lynn, you said the reality is that most private companies are not large enough to access the public credit market. How do you define a large company versus a small company?
Sure. It's a bit of a tricky answer, but I would say rule of thumb for me is companies with approximately $100 million of cash flow or EBITDA. And if they're seeking an average level of leverage, call it 5 times cash flow, that's about $500 million of leverage. That is a scalable transaction that the intermediary banks will represent the borrower and raise capital for that borrower through the public credit markets. South of that $100 million of cash flow, it gets a little trickier, and the amount of debt being raised becomes less interesting for the banks. And that's where private credit lenders might be more involved.
Interesting. Okay. And certainly those of us who follow the news have maybe heard private credit come up a few times over the past few months here. And a lot of what we've been hearing in the news coverage indicates that the private credit market is feeling a little bit of stress right now. What are some of the key issues that investors are expressing concerns with?
Yes. So there's been a dizzying amount of news recently about the market. A general observation I've made is that some of the coverage seems to conflate several different concerns into one big crisis. So we can try to summarize a few of those concerns as we understand them. First, there is a narrative that there is a lot of embedded stress in the private credit system. It really picked up steam late last year. There were a couple of high profile bankruptcies, both in the auto industry, that spooked the markets. Neither of them involved traditional private credit investments, and both had elements of simply bad business practices and fraud. However, they were linked to potential broader cracks in the private credit market, which we have not yet observed in our portfolio. The news coverage around those potential headwinds caused further concerns, particularly from high net worth investors who are asking to get their money back from their private credit investments. Unlike SWIB, these investors typically access the market through what we call open-end funds that provide some liquidity. Usually it's about 5% of net asset value on a quarterly basis. So when the manager is being asked for more than 5% in a given quarter, the investors are given a portion of their investment and being told to wait until next quarter. The investors might not like it, but this is the intended design of these open-end vehicles so that the manager is not forced to sell assets at deep discounts.
Like Lynn said, SWIB does not invest in these types of funds with the open-ended structures and the possibilities for redemptions. You'll hear them also referred to as BDCs. Funds with that structure are about 20% of the market. And the other 80% where we do participate are in funds with institutional structures where you take on the illiquidity risk and there are no redemption features. And that's a really important distinction because the fund structure matches the nature of the investments in an institutional structure. So the focus can be all on the underlying operations and financials of the businesses. It's not impacted by the volatility and the sentiment of retail investors wanting redemptions. I also want to mention that part of the noise has been in software, and you've probably heard headlines about stress and cracks in software, and that's led to some of the redemption requests that we're talking about here. Private credit has been a meaningful lender to software companies. About 26% of the private credit market is in software. And it's getting a lot of attention because of the increasing concerns around Anthropic and AI tools posing challenges to the business models of software companies in the future. You saw the re-rating of software in the public equity market. You've seen pricing on publicly traded loans trading down in software. And to bring that back to private credit, the exposure that private credit funds have, again, on average is 26%, but in some of these BDCs is upwards of 40 to 60% or even higher. And so these vehicles have had the redemption structure and that noise, which has gotten really loud in the headlines in response to the software news. For SWIB, in our current return portfolio, which is where we invest in private credit, software exposure is 13%, so significantly below the market. And we feel okay with that positioning right now. And we also believe that there's a disconnect between the market noise of pricing and the fundamentals that are still healthy for the right companies in software.
I think that's right, Beth. We think it's always good to be cautious, and the market has legitimate reasons to be concerned. But those concerns are a bit ahead of the data.
So I think right now, when you look at the economy overall, there are some people that would probably consider it to be in a rough patch now. But what happens to these investments, and what does that mean for the WRS trust funds if and when the economy hits a rough patch?
Well, you're certainly right. The economy has its hands full with sticky inflation, with the war in Iran, with oil prices. When the economy hits a rough patch, the impact and stress level will be a little different for each sector and also different for each company for a variety of reasons. So, the thing that we and our investment managers follow most closely are the financial and the operating metrics for the companies in our portfolio. We follow normal health metrics like the debt levels, the profitability, the interest coverage for the loans. But more specifically, if a company starts to be stressed, you tend to see it first in things like that company electing to switch from cash pay to a PIK, which is a payment in kind feature, if they have that option in their loan documents, or you'll see a company miss a covenant. A covenant is a financial metric that they need to maintain in their loan agreement to be in compliance. And if these things start to happen, the company will ask to renegotiate and amend the loan documents. That means that they'll ask to change some terms and be given more time in most cases. And then eventually, if things keep getting worse, then there will be a default and a restructuring. But there are a lot of signals, as you can imagine, from what I just said, that happened before that. So SWIB is invested in credit funds, and we stay informed on these metrics through the funds that we invest in. But ultimately, we do believe that, yes, it is a rough patch in the economy. We expect defaults to rise. Defaults have already started to rise a little bit, but they're rising from very low levels, and they remain fairly low compared to historical metrics. And we're watching it. We like where we sit in the credit because most companies that encounter some stress will still be good credits. And you have to remember that it's a debt instrument that's at the top of a capital structure, and you still have significant equity protecting you.
Yeah, and from an alternative perspective, we're always considering opportunistic ways to capitalize on market stress and dislocation. So, for example, we're actively positioning to play offense in this market for increased redemption activity by partnering with the credit secondaries manager, specifically to offer liquidity to those that need it. This is a new mandate in our portfolio, but we're excited at the opportunity given some of the liquidity needs that are playing out in the market in both open-end funds and closed-end funds. Ultimately, this portfolio for SWIB is roughly 4% of the core trust fund and is very diversified across sectors, geographies, strategies, managers, and thousands of companies. And to take diversification further, we have investment strategies in this portfolio beyond corporate credit, but have a current yield component, things like royalty interests in content and energy that are generally uncorrelated, GP stakes, and other off-the-run financial assets. We've also recently expanded a little further into Europe, which is really 10 plus countries. This enhances portfolio diversification. And I hope I'm being clear. Diversification is our friend, and we use it for downside protection.
So it seems like every time we do a podcast and we're talking about the economy and the markets, interest rates come up. That's a topic that we can't seem to escape just because they impact every type of investment. How do interest rates impact this portfolio?
Well, it's the answer that you just foreshadowed. They do affect the portfolio. Returns in private credit move with interest rates, and that means that returns generally have come down recently relative to a couple years ago. I'll use the example of senior debt investments. You could make a senior debt investment with returns that, using a very modest amount of leverage, would get you to low to mid teens. That was a very good market to invest for high returns at the top of the capital structure. And we did a number of credit co-investments during that window. It was very good for our portfolio. That market has moved away for now. Interest rates have come down a bit. So it means that overall that opportunity for our portfolio won't be as high yielding. Our managers can sometimes strategically shift between, if they're investing in fixed or floating rate structures, they'll seek to opportunistically maximize what the return can be. They'll also shift to special situations that can still get them higher rates. And it really speaks to what Lynn mentioned is the diversification of our current return portfolio. I mean, that's why we invest in different types of assets, so that we can diversify by including things like the royalties and the GP stakes that he mentioned that are not correlated with interest rates.
So you kind of built in a little bit of that protection, just like the core fund overall is diversified to protect. Your portfolio kind of mimics that in a way to protect itself, right? Or to help when there are stresses in the market.
Absolutely. Yes.
I think we've done a really good job so far of sort of outlining some of the concerns around private credit and how those concerns that we might hear about in the news are really not applicable to what we have going on at SWIB and in the core fund and its investments. But I think it's also worth highlighting that the reason that we're investing in private credit is because there are a bunch of benefits that are available as well. What are some of those benefits?
I would generally start by saying SWIB is a long-term investor, so our investment philosophy is rooted in this perspective. Since the public and private credit markets operate very differently, as I mentioned earlier, that relationship offers SWIB diversification, which is a key reason why we allocate to the private markets for the core trust fund as part of our long-term asset allocation strategy. Specifically, this private credit portfolio has been a strong performer for the core trust fund, having generated strong absolute and relative returns consistently over the last several periods. A portion of those returns comes from contractual current income, which helps to de-risk an investment during its life. And those returns are in excess of the equivalent returns we would have generated had we invested in the public credit market over those same time periods.
So how then do you choose the firms with which you invest, and what do you look for in a firm that you want to invest with?
So this is the bulk of where Lynn and I spend our day-to-day time. It is the most important part of our jobs. And it comes down to a handful of things. One, we assess the strategy of that firm. What level of risk are they taking, and what types of returns are they underwriting to? We also look at how they view the market opportunity and how we view the attractiveness of the market opportunity that they're going to invest in. And interest rates are a part of that. Interest rates are going to determine the return profile specifically for credit. And it's going to determine how we view that strategy relative to everything that we're investing in the current return portfolio. If it's a market environment where you can make low teen returns on a senior debt investment, then we're going to lean into that. At other times, we may look for more diversification. So we focus a lot on the attractiveness of the market opportunity and how that fits the strategy of what a firm is saying they're going to do. Another factor is the level of company diligence that these private credit firms do. And this is where I really like the synchronization between our private equity managers and private credit, because they can leverage their private equity teams for the market knowledge and the history of selecting good assets. And by doing that, have a good track record of avoiding losses. Avoiding losses is really important in a private credit portfolio. And so many of these firms are sector specialists, and they really have a special angle at knowing which companies are set up well to have good financial metrics and be a good credit investment. Two more things. And the next one is probably the most important when we're talking about times of market stress. And that's we want a manager that has a skill set that if they do take over a company in a restructuring, then they can be an owner operator of that company and position it better for recovery. Not all private credit managers do that. It's certainly a differentiation between private credit and banks, and we look for that as a skill set. And then the last thing, and what's kind of at the top of all this, is the team behind the strategy. We want it to be a team that we have high conviction in, that we know over time, and we focus on the level of alignment that that team has with how we're investing in their fund.
So the WRS pension benefits are heavily influenced by investment returns. So I guess it's fair to ask, how have SWIB's investments in private credit done for the core trust fund?
Our team works really hard to get ahead of the most attractive investment opportunities and select the best managers to execute on behalf of SWIB. I alluded to the portfolio's returns earlier, but getting a little more specific, after paying fees to managers, the portfolio has generated 11 to 13% returns over the last 1, 3, and 5-year periods. And for those periods, consistently ahead of the portfolio's benchmark returns. These returns are an example of the accretive potential of private markets and specifically the private credit market for the core trust fund.
As we wrap up our discussion today, what's one thing you would want WRS participants to remember about private credit as they continue to see headlines about the stresses and what's not good about private credit? What's one takeaway you would want participants to remember?
I think one thing to remember when they hear about redemptions and stress is that those are in open-ended investment vehicles that SWIB isn't participating in. SWIB might have similar asset exposure. It's a loan to a company, but we're investing in an institutionally structured fund that's so important because the illiquidity of that fund matches the nature of the loans that are made to those companies. And so even a company that's going through some stress, unless it becomes a situation that's a restructuring and default, is still going to be a credit that gets a yield that produces the returns that Lynn mentioned in our private credit portfolio. And that's good for SWIB and our participants.
So the only thing I would add is we're in a moment in time or a window in time where there are a lot of questions being raised about a particular asset class. But I would like everyone to understand that we approach this asset class here at SWIB with that long-term investment philosophy that I mentioned earlier. And we've designed and constructed this portfolio to be durable over a long period of time, going out 10, 15 years, as opposed to a window of 6 to 9 to 12 months.
Well, Beth and Lynn, thanks for taking some time out of your schedules to chat with us about private credit and its impact on the WRS trust funds. You gave us a lot of good information and really explained how SWIB is using this asset class to continue to find opportunities in the markets and benefit the WRS trust funds. Thanks again for joining us on the SWIB podcast.
Thank you. This is great.
Thank you.
And thank you to all our listeners for checking out this episode of the SWIB podcast.
The SWIB podcast is brought to you by the State of Wisconsin Investment Board and produced by PodCamp Media. Branded podcast production for business is podcampmedia.com with editing by Matt Covarrubias.
Thanks again for listening. I'm Chris Preisler.
And I'm Dusty Weiss.